A hot morning in Ogden, Utah, August 1931. By the time the doors of the Ogden State Bank open at 9 a.m., a crowd of 300 people has been waiting since before dawn. They are farmers, widows, factory workers, small business owners. Every one of them has their entire life savings in this bank, and every one of them just heard that a sister bank, owned by the same family, failed yesterday. They are here to take their money out. All of it. Today. The doors open. The crowd surges into the marble lobby, voices rising, hands shoving forward, tellers behind the counter looking terrified. There are exactly two outcomes possible in the next 30 minutes. Either this bank survives, or it doesn't. And if it doesn't, 300 families will walk home with nothing. 41-year-old Marriner Eccles steps forward. He is thin, soft-spoken, a small-town Mormon banker who inherited his father's businesses at 22 and has spent the last 20 years running banks in the middle of nowhere. He climbs onto the marble counter, stands up, looks out over the crowd. And what he is about to do in the next 4 minutes will not just save this bank. It will, almost by accident, give him the idea that will save American capitalism. But to understand why a small-town banker from Utah ended up rewriting the rules of the modern economy, you have to go back 10 years. Back to Washington. Back to a thin, pale man who looked like a tired bookkeeper and was actually one of the richest people in the world. His name was Andrew Mellon, and in 1921, he became the most powerful man in America. Andrew Mellon did not look like a titan of industry. He was thin, pale. He spoke so softly that visitors had to lean across his desk to hear him. A reporter once described him as a tired bookkeeper who had wandered into the wrong building. The tired bookkeeper was worth, in modern money, somewhere around $7 billion. He had inherited a small Pittsburgh bank from his father at age 27. 40 years later, he had turned it into an empire. Aluminum, steel, oil, coal, railways. If you flipped the light switch in 1925, there was a good chance Andrew Mellon owned a piece of the wire, the bulb, and the power plant burning the coal. He was the third richest man in America. Only Henry Ford and John D. Rockefeller were wealthier. In 1921, President Warren Harding appointed him Secretary of the Treasury. Mellon would hold that job for almost 11 years, under 3 presidents, through the boom of the 1920s and the first 3 years of the catastrophe that followed. He had a philosophy. He never deviated from it. Wealth, in Mellon's view, naturally flowed downward when accumulated by the right people. Taxes on the rich destroyed this flow. Government spending was theft, and economic pain was useful. When the economy stumbled, it was the system clearing out weakness. To prop up failing banks or feed the unemployed was to cheat the system of its corrective power. Over 5 years, through 3 separate tax cuts, Mellon engineered the largest reduction in taxes on the rich in American history. The top marginal rate fell from 73% down to 25%. A tidal wave of money rushed to the top of the American economy, and it did exactly what Mellon believed it would do. It invested. The problem was what it invested in. Between 1921 and 1929, the Dow Jones rose by nearly 500%. Some of it was real. Electricity reached most American cities for the first time. The automobile became ordinary. Factory productivity doubled. But by 1927, the market was no longer rising because companies were earning more. It was rising because people were buying stocks. And people were buying stocks because the market was rising. Most of these stocks were being bought on margin. 10% down, 90% borrowed. Your barber was doing this. Your aunt in Dubuque was doing this. Shoeshine boys were giving stock tips. The country was placing the biggest bet in its history, with money it didn't have, on companies it didn't understand. And the wealth created in the 1920s wasn't being shared. By 1929, the top 5% of Americans took home a third of all the country's income. Wages for ordinary workers had barely moved in a decade. Andrew Mellon, watching from the Treasury, was not concerned. The Federal Reserve raised interest rates once, weekly, in 1929, then stopped. The casino had already swallowed the country. 2,000 miles west of Wall Street, in Ogden, Utah, a young banker named Marriner Eccles was reading his loan files. Picture a small office above a Main Street storefront. A desk piled with manila folders. The folders are loans his banks have made to farmers across Utah, Idaho, and Wyoming. What Eccles sees is this. The farmers aren't borrowing to expand. They're borrowing to pay last year's loan. The factory workers in Ogden are buying refrigerators on installment plans they cannot afford. The boom in the cities is running on credit. The countryside isn't booming at all. Eccles has no formal economics training. He has a feeling. The feeling that the math isn't working. In October 1929, the trigger arrived. On Thursday, October 24th, 1929, the New York Stock Exchange opened to a wall of selling. 11% gone in the first hour. Margin calls demanding more money from people who didn't have any more money to give. The following Tuesday, the market lost 12% in a single day. Within 3 weeks, $30 billion had evaporated, roughly $500 billion in today's money. Gone. Across the country, millions of ordinary Americans, people who had been told by Mellon's treasury that the boom was sound and the rich knew best, watched their savings vanish. Lifetime savings, factory workers' pensions, widows' inheritances, gone in days. In the White House, President Herbert Hoover called an emergency meeting. Andrew Mellon was there. Hoover asked him what to do. Mellon's answer would echo through American history. Liquidate labor, liquidate stocks, liquidate the farmers, liquidate real estate. It will purge the rottenness out of the system. People will work harder, live a more moral life. Enterprising people will pick up the wrecks from less competent people. Hoover, to his credit, was horrified. He would later write that Mellon and the men who thought like him were the leave-it-alone liquidationists. But he could not bring himself to overrule them. Not yet. So the federal government did essentially nothing. The Federal Reserve did worse than nothing. Between 1929 and 1933, the U.S. money supply contracted by about 1/3. The institution whose entire purpose was to prevent exactly this disaster sat back and let it happen. When the money supply collapses, prices fall. That sounds good, but if you took out a mortgage in 1928, the dollar amount of your debt didn't fall. Only the value of what you could earn fell. Everyone who owed money was, mathematically, being crushed in slow motion. By 1931, 9,000 banks had failed. The American economy was in freefall. And in a small marble lobby in Ogden, Utah, 300 terrified people were about to demand their money back from a small-town banker who had figured out the secret nobody else had. The crowd is shouting. Eccles, standing on the marble counter, holds up his hands. He tells them the truth. He tells them, yes, a related bank has failed, but that this bank is solvent. He tells them that if everyone tries to withdraw at once, the bank will fail, not because it is weak, but because no bank on earth could survive everyone demanding their money on the same day. He tells them he is instructing the tellers to count out every single withdrawal, slowly, by hand. The tellers count slowly. They smile. They chat. Eccles sends runners to other banks begging for emergency cash, which arrives in armored trucks. He makes sure the trucks are unloaded visibly in front of the waiting crowd. Cash, stacks of it, walking through the front door. By the end of the day, the crowd has calmed. The bank has survived. Every Eccles bank, in fact, will survive the Depression. Not one will fail. And Eccles, watching from his marble counter, has figured something out. A bank run is not a problem of weak banks. It is a problem of frightened people. And an economy is not a machine that purges itself. It is a machine that, once frightened, eats itself alive. He could not have known that morning that the rest of his life would be one long attempt to build a counter big enough for the entire country to see. By 1932, the Depression had become global. The Dust Bowl had turned the American Midwest into a desert. The Smoot-Hawley tariff had collapsed world trade by 2/3. Every country in the world was fighting a fire by turning off the water. And through all of it, Andrew Mellon kept saying the same thing he had been saying for 30 years. Be patient. Cut spending. The market will heal itself. It was not healing. In January 1932, something happened that had never happened before in American history. Congress began drafting articles of impeachment against a sitting Treasury Secretary. The charges were brutal. Tax fraud. Mellon, the man who had cut taxes on the rich, was accused of structuring his own taxes through dummy charities to avoid paying them. Conflicts of interest. Mellon had used the Treasury to favor companies he secretly owned. The Senate Judiciary Committee summoned him to testify. For the first time in his life, the third richest man in America was being publicly humiliated. Reporters described him as gaunt, visibly shaken. The man who had told America that suffering was useful was now suffering, in front of the entire country, on the front page of every newspaper. Hoover, terrified of an impeachment vote that might happen, ended the proceedings the only way he could. He appointed Mellon ambassador to the United Kingdom, a job that required him to leave the country immediately. Mellon sailed for London in February 1932. He left behind the wreckage of his philosophy. He would never live in the United States again. That November, Hoover lost the presidency in a landslide to Franklin Delano Roosevelt. Roosevelt did not know exactly what he was going to do. He had 4 months until inauguration and a country in freefall. While he waited in the dead of winter, the Senate Finance Committee in Washington was holding hearings, trying to figure out what had gone wrong, trying to find anyone with an answer. February 13th, 1933. A Senate hearing room in Washington. The country has been bleeding for 3.5 years. The Finance Committee has been calling witnesses for weeks. Bankers, economists, industrialists. Everyone has said the same thing. Be patient. Cut government spending. The market will fix itself. Today's witness is different. He is the same Mormon banker who had stood on the marble counter in Ogden 2 years earlier. Marriner Eccles. He had been invited to testify because he was, almost uniquely, a banker whose banks had not failed. Senators wanted to know how. He sits down, he opens his folder, and he tells the most powerful men in American finance that they have caused the Great Depression. Not the weather, not the Europeans, not bad luck. Them. The rich, he says, captured almost all the gains of the 1920s. By 1929, the top 5% of Americans took home 1/3 of all the country's income. Wages for ordinary workers had barely moved in a decade. Eventually, regular Americans couldn't afford to buy what the factories were making. That's when everything broke. He tells them the government must put cash directly into the hands of the unemployed. He tells them the Federal Reserve has been doing the exact opposite of what a central bank is supposed to do. The senators stare at him. One will later say it was like watching a man walk into a cathedral and casually explain that God had been wrong. 3 weeks later, on March 4th, Franklin Roosevelt was sworn in as president. Somebody handed him a transcript of the Eccles testimony. Roosevelt read it. Then he asked his staff to find this Mormon banker from Utah and bring him to Washington. Marriner Eccles arrived in Washington in early 1934, expecting to spend a few weeks as an advisor. He stayed for 15 years. What he had figured out, standing on his marble counter, was something the trained economists of his era had largely missed. A modern economy runs on spending, not on saving, not on virtue, not on liquidation, on the simple fact of money moving from one hand to another, from a customer to a shopkeeper to a wholesaler to a farmer to a worker to a customer again, round and round. When ordinary people stop spending, businesses lose customers. Businesses fire workers. Fired workers stop spending. The cycle accelerates downward until the entire economy is in free fall. Mellon's solution was to wait for the system to heal itself. Eccles' solution was the opposite: interrupt the cycle by force. The federal government would have to spend money it didn't have, put cash directly into the hands of the unemployed, and let the cycle spiral upward instead of down. A British economist named John Maynard Keynes was working out a similar theory across the Atlantic. Keynes would get most of the academic credit. Eccles, who had arrived at the same conclusion from inside a collapsing bank lobby, would get something more important. He would get the policy machinery. In November 1934, Roosevelt named Marriner Eccles governor of the Federal Reserve Board. Within months, Eccles had drafted legislation that would rename his own job and rebuild the entire American financial system. The Banking Act of 1935 ripped power away from the regional Federal Reserve banks, many of them run by the same Wall Street figures who had presided over the collapse, and handed it to a board of governors in Washington, accountable to the public. The deposit insurance system Roosevelt had signed into law 2 years earlier was made permanent and given teeth. From that day forward, if your bank failed, your savings did not vanish. The bank runs that had killed thousands of banks, runs like the one Eccles had stared down from the marble counter in Ogden, became, almost overnight, an artifact of history. And then Eccles went further. He pushed for direct federal employment, the Works Progress Administration, the Civilian Conservation Corps. Within 5 years, millions of unemployed Americans were put to work building roads, bridges, post offices, dams, and one massive concrete wall in the Nevada desert that would later be named, with cosmic irony, after the president who had refused to act. Every one of these programs was the same move Eccles had made on the counter in Ogden. Climb up where everyone can see you. Tell the frightened crowd that the country is solvent, that the cash is coming, that the tellers are counting. Make the calm visible. Make the calm contagious. And quietly, in private memos to Roosevelt, Eccles made an argument the president had not yet fully embraced. The wealth concentration of the 1920s, the inequality that Mellon's tax cuts had accelerated, had been, in his view, a primary cause of the Depression itself. Too much money in too few hands meant too few customers for what the economy could produce. By the time Roosevelt began echoing the argument in public, Andrew Mellon was dying. Andrew Mellon died on August 26, 1937. He died with his reputation in ruins. The phrase, liquidate labor, liquidate stocks, had become historical shorthand for everything that had gone wrong. But in the last years of his life, Mellon did something almost no one expected. He had spent 40 years quietly building one of the greatest private art collections on earth: Vermeers, Rembrandts, Raphaels. In 1936, he wrote a letter to President Roosevelt, the man whose entire program he had opposed. In the letter, Mellon offered the United States government his entire collection for free, along with funds to build a museum to house it. He asked for only one thing in return: that the museum not bear his name. The National Gallery of Art opened in Washington in 1941. Tens of millions have walked through its halls. Almost none of them have any idea who paid for it. Marriner Eccles served as chairman of the Federal Reserve until 1948. He retired to Utah and lived another 29 years. He died in 1977. In 1982, the headquarters of the Federal Reserve Board was renamed the Marriner S. Eccles Federal Reserve Board Building. It sits on Constitution Avenue, about a mile from the National Gallery of Art. If you walk between the two buildings, you are walking through the geographic center of an argument that has not actually ended. In 2002, at a celebration of Milton Friedman's 90th birthday, a Federal Reserve governor named Ben Bernanke addressed Friedman directly. Friedman had spent decades arguing that the Federal Reserve's passivity in the early 1930s was the single greatest cause of the Great Depression. Bernanke, who would soon become Fed chairman himself, said this: "You're right. We did it. We're very sorry. But thanks to you, we won't do it again." 6 years later, in 2008, Bernanke faced a financial crisis that many believed was structurally similar to 1929. Banks were failing. Credit was freezing. The money supply was contracting. This time, the Fed did the opposite of what it had done in 1929. It flooded the system with liquidity. It cut interest rates to near zero. It bailed out, took over, or restructured nearly every major financial institution in the country. In other words, Bernanke climbed onto the counter. The crowd calmed. The system survived. Whether the price of that calm, the asset booms, the bailouts, the deepening gap between those who owned and those who worked, created the next crisis is an argument we are still having. Systems are made by people. People like Andrew Mellon, who believed wealth at the top would heal everything, that suffering was instructive, that the role of government was to step aside, and that the strong inherit the earth. And systems can be remade by people. People like Marriner Eccles, who stood on a marble counter in a Utah bank lobby and figured out, in about 4 minutes, that an economy is not a machine. It is a crowd. And the frightened crowd will tear itself apart unless somebody, anybody, climbs up where everyone can see them and tells them it is going to be all right. The Great Depression wasn't a freak accident. It was a system failure. And systems can fail again.